2025 has been an insane year for investors so far, with all-time highs and crashes, recession fears, tariffs, and all sorts of drama. But one of the craziest things happened this last week. Canada's TSX has hit a new all-time high. So in today's video, we're going to talk about how we got to this point, why Canada is outperforming, and whether or not Canada is going to continue outperforming through the rest of 25. And this is a good place to park your money now. Welcome to Golden Arch Investing. My name is Liam. On this channel, we talk about investing in Canada. That interests you at all, please do like the video, subscribe to the channel. So today we're going to cover what has happened over the last year, and of course, sort of the predictions coming for the next year. And we're going to use some of the smartest people on the block. We're going to talk about Bank of America. Let me toss an article up on the screen for you here. It says TSX outperformance could hold Canada cycle indicator nears 2-year high BOA. Now, to understand how TSX has got here is a dramatically complicated procedure. To really break down every single little detail that got Canada to this point, to understand the sort of questions about the US dollar and questions about investing in America and the sort of patriotism around Canadians piling their money into Canadian companies, or at least the concept of that. Of course, then we have all the geopolitical stuff about, if Canada's a safe place to put your money or not. And then we have a new government who's promising the moon when it comes to Canada's economy. There's just so much going on. But if I had to sort of sum it up into a few sentences, I would say that Canada represented a great value coming into 2025, got hit early with the tariff threats, and has now seen itself sort of raised by others getting cut down worse than us. And we have seen some of Canada's best companies, the defensive companies, the financials, the utilities, the grocery stores, the railroads, show that Canada's defensive nature is actually a huge virtue at times of huge instability like this. But today's video is really about the future. So let's cover why Bank of America thinks that the TSX could continue to outperform and what it is exactly that gives them the confidence and whether or not we should use that confidence when making our own investment decisions. So this is an article by Luke Jurek. It was written Friday, May 23rd. So just yesterday as I published this. It's from investing.com. I'm reading it here on Yahoo Finance. So the TSX has outpaced the S&P by 5% year to date. Bank of America Securities expects the momentum to persist. Strategist Tyson Dennis Sharma notes that the firm's Canada Cycle Indicator, or CCI, a composite macro gauge, remains near its highest level in 2 years, pointing to continued relative strength in Canadian equities. Historically, when the CCI is positive, the TSX has outperformed the S&P 500 60% of the time by an average of 4.1 percentage points per month. That's pretty significant. That compares to just a 23% hit rate and an average underperformance of 5.9 percentage points when the indicator turns negative. So it seems like this indicator has a fairly high correlation. 61% or 60% of the time, and a 4.1% average is pretty impressive for an indicator. I mean, I'm not a technical analysis guy, but even I understand that indicators are, usually this happens. It's not often you'd see an indicator much higher than 50, 60. CCI's strength stems largely from earnings momentum, the TSX earnings revision ratio standing 20% above that of the S&P 500. Canadian bank earnings have supported this outlook as S&P TSX 60 earnings per share growth is tracking 10% higher year over year, marking a second consecutive quarter of positive growth. I should say, as this article is published, I think the only big bank that's reported their earnings is TD, and they killed it. I'll give them that. They killed it. But important to note, valuation, dividend yield, and sector positioning are additional tailwinds for the TSX. We talked about this just a moment ago, right? Canada was really sort of conservatively valued. Our multiples were nowhere near as stretched as the US economy. The index trades at 21% forward price to earnings discount and a 57% discount on a price to book basis compared to the S&P 500. Dividend yield of 2.8 is more than double that of the US benchmark. Notably, the TSX offers outsized exposure to gold through its metals constituents, which has been huge. We've talked about that this year. TSX 0.15 relative gold beta implies 15 basis points of outperformance per 1% rise in gold. So for frame of reference, that would be 0.15% performance every time gold rises 1%, which is not bad, right? I mean, you don't want a huge beta to gold because, as we've seen, gold can act like Bitcoin sometimes when people are really scared about the dollar, as we saw with gold shooting upwards. But like Bitcoin, it can also crash. TSX hit record high. record highs following Canada's recent federal election as investors embrace post-election optimism on trade and fiscal support. Bank of America expects the effective U.S. tariff rate on Canadian exports will stabilize around 5%. More firms qualify for exemptions under USMCA, and the government shifts towards export diversification. Fiscal and monetary policy further bolster the case for TSX exposure. The Carney administration pursuing stimulus, and the Bank of Canada expected to cut rates 3 times this year versus none by the Fed. Whoa, none. They're predicting none already? It's only May. I did not realize that. The Bank of America doesn't think that Fed's going to cut at all. I would expect the Fed to cut this fall, personally. And this is just based on what I've seen out there. And, as long as they get enough data that they don't do it because Trump told them to, I think they'll do it. I imagine they want to. Interesting. Canadian markets may benefit from a widening policy differential that eases financial conditions relative to the US. I should say Canadian dollar probably won't benefit from that. That has been one of the things we talked about with the Canadian dollar underperforming. Dennis Sharma highlights the TSX has historically outperformed during minority governments like the current one. This, combined with more anchored inflation expectations of Canada's commodities exposure, could help keep the TSX on a structurally stronger footing. I think that's really interesting. One of the things I would say, Canada is looking good from a sort of stock market perspective. The economy is not looking quite as great. And as a Canadian investor, you might tend to sort of combine those two things together in your head. You might think, hey, I'm seeing headlines saying recession in Canada, but the TSX has hit all-time highs. What's up with that? Well, I think a big part of that comes from the fact that I think it's over 50% of the biggest companies in Canada that get more than half their earnings from outside of the country. So like a significant chunk of earnings that are coming into Canada through TSX-based companies are coming from outside. Think about the banks. We talked about this. Their growth drivers are not necessarily in Canada. Now, some growth drivers absolutely are. The gold growth driver is absolutely in Canada. And we cannot pretend that that hasn't been a huge part of what's kept us not only afloat, but outperforming so far at the start of this year. With gold hitting, all-time highs after all-time highs throughout a lot of the, the April and US fear era that we had there. That absolutely definitely strengthened the economy here, definitely strengthened the TSX, and it really sort of overrepresented gold. Now, do I think that's going to continue? Maybe, maybe not. Remember, the gold stocks are in the index. And so gold stocks being in the index means that if those gold stocks continue to run, thanks to gold remaining higher and their costs staying, maybe not quite flat, but relatively flatter, you could see those stocks continue to sort of, gain momentum. Any sort of commodity-based company, when that commodity shoots upwards, they're killing it. We've talked about this with natural gas in Canada. We've talked about this, the potential of this in oil. It's been huge for the gold companies. And so the stocks might hold up better than expected for those that are, maybe short-term bearish on the price of gold, thanks to hopeful return to normalcy in trade throughout the rest of 2025. But, even with those guys getting out of the way, now the question is, okay, what about the banks? I think the banks are in a really good position. The banks have done a lot of the work over the last month. Banks are up a huge amount. I think we're looking at like 30% or something crazy over the last year for a lot of these big banks, which would represent, a 10% run in the last month ever since the dips. And so seeing that, now you start to question, TD killed their most recent earnings. Are the others going to follow that? If they do, that's fantastic. Maybe they'll continue to outperform. What is it that gives them structural stability? Well, okay, rates dropping here in Canada is good for Canadians. Now, of course, if we see this mortgage crisis in Toronto and Vancouver continue to expand, that's really bad for the banks. At the end of the day, basically all money loaned in Canada comes from those banks. So if you see the mortgage crisis get worse, expect to see the bank stocks drop. If you see, unemployment start to tick up, you see real recession here in Canada. And I'm not talking just like a literal recession where GDP drops for 2 consecutive quarters, but I'm talking about severe unemployment. I'm talking about companies going bust. I'm talking about like actual real difficulty in the economy, not just this like slow grind difficulty that all of us Canadians have experienced the last little while. Expect the bank stocks to drop. But apart from that, they're basically, it's not quite clear skies ahead. There's some clouds, but it's not as bad as it could have been. It's not as bad as it could still be. We've also seen some chatter about maybe changing US tax rules, and that might not be helpful for the banks, but that's a whole different story. So, okay, banks look pretty good. Not fantastic, but pretty good. So now let's look at some of our stability, some of our stable, slow growth companies. I would say that some of the ones that you want to look at here, you'd consider groceries. Grocery stores in Canada, we got basically an oligopoly of big grocery brands. It's like the Loblaws brands, you got the Empire Foods brands, you got the Metro brands. They've been doing pretty good this year. Actually, Canadian consumers have increased spending year over year, which is pretty impressive. And with the carbon tax gone, maybe there's an argument that some of their pricing is done better. Maybe there's actually a little bit of a Buy Canada move and it helps these guys out. So grocery stores look okay. Telecoms, I wouldn't touch the 10-foot pole, but you already knew that if you watch this channel. And that's mainly just because of like real short-term buys. Now, does that mean the telecoms aren't a good investment? No. It just means that I personally have seen a lot of challenge there. They've been like dragging each other down like crabs in a bucket. And we'll see. This could be the bottom, and this could be a great time to buy. But we'll see. We'll see what happens. I don't understand that market well enough to invest in there, but a lot of investors love it. They profit from those great dividends. RIP to BCE shareholders who bought in just for that crazy high dividend yield over the last couple of months. But to everybody else, the TELUS and the Rogers guys, I'm sure you're pretty happy with the dividend, and hopefully that stays stable and consistent for you. And that's a good source of stable, consistent income for a lot of portfolios. And then we think about maybe the pipelines. Well, they're doing pretty good. They're consistent, they're growing, they're slow, they're even diversifying a little bit. There's some opportunities for them in the next little while. Maybe there's significant expansion opportunity, maybe not. But I would say at the very least, they look like they are pretty agnostic to the price of oil over the last little while. Looks like producers are going to keep producing here in Canada, unlike the threat down in the States. And so maybe they're going to just keep trucking along and continuing to return those fantastic dividends, and that stability stays. And so you're looking for outperformance in other places. Now, one of the places you have found it for sure, and I'm ready for the comments. I can see it happening in my head already. Brookfield and Fairfax, who are these big conglomerate financials, yes, but not banks. They are sort of owners of other companies. They're the Canadian Berkshire Hathaway. They've killed it this year. They've killed it. They absolutely have. I think we're talking like, I'm going to be off the top of my head here. I'm going to say like 40% over the last year. Could be wrong, but killed it. Have done fantastic and have seen a significant rebound since the lows, maybe earlier in the spring. Maybe not early spring, but earlier in the spring. So with those guys killing it, are they going to continue to kill it? I kind of think so. I think you can also see that same sort of story with some of Canada's infrastructure companies, or maybe like the WSPs, or even the major infrastructure firms, where you could really see like significant growth in investment in Canadian infrastructure, and these guys just make a huge amount of money. I think that will also bring a huge amount of money into the banks. Maybe that'll make up for any sort of potential tariff induced recession or significant job losses at auto plants or resource industries, specifically like timber, lumber, metals, not necessarily on the mining side, but like the industrial processing side. Maybe if we see that sort of dip a little bit, we'll see some of that eased by increased infrastructure spend, right? Maybe we'll see more railroads or something along the lines of major infrastructure. I mean, we've heard it in the news every single day. Again, I talk about this stuff with students. We're constantly seeing stories in the news. I know we saw one recently talking about, the premiers of Western Canada have agreed there's going to be a big, infrastructure projects going all the way from the Hudson's Bay to the Pacific. Sick. What does that mean? Show us. Tell us, please. We would love to hear that as Canadians. We'd love to see where those infrastructure dollars go, what benefit that brings our economy. And as investors, we would love to see who's involved. What does that mean? Are we talking just a pipeline? Are we talking a railroad? Are we talking new ports? Are we talking just like generally new opportunities in different industries? Because that could be a huge benefit to our portfolios if it's made clear what happens and if the investment gets made. So those big financials could, again, not necessarily, but could be huge beneficiaries. So you look at all of those things combined, and there's a lot of pros going for Canada. I think one of the final pros, it's on the screen beside me still. the US effective tariff rate on Canadian exports is going to stabilize much lower than most other firms. If you think about the threat, I mean, just yesterday we saw 50% tariff threat against the EU? Crazy. The China tariff war thing is stabilizing at 30 with, only however many more days it is left, right? Somewhere in the 70s, I think, days left before that deal expires and we see what happens. So there's a lot of uncertainty amongst a lot of other markets internationally, and it's causing related uncertainty in the US market. Canada seems to be the, safer option right now. So there's a lot of things lining up for Canada. And at the end of the day, no matter what you decide to do, I think that Canada is a great place to invest. I also think diversification is important. I think for my generation, we've seen this story play out. Things are not going to stay the same forever. It feels like for a long time, the smartest choice was to buy an S&P 500 index fund and don't think about it. Ever since 2008, we had almost 20 years, right, of fantastic outperformance for the Americans. Year on year on year, we saw American brands outperform. We saw American indexes outperform. We saw American stocks, become the largest companies. That story might not end, but it's definitely less certain than it was before. And so diversification has become more important than ever. I think Canada offers fantastic opportunities no matter what you like to invest in. I personally am a dividend growth investor. I'm looking for long-term opportunities. I like to play into asymmetric trends. I like to, play individual stocks. I'm a very specific kind of investor. Most investors don't invest like me. There's a lot of dividend investors. There's a lot of conservative investors. There's a lot of sort of ETF broad-based investors. But there's something in Canada for everyone, and it looks pretty great. So if you're interested in banks, Canada's a great option. You're interested in pipelines, Canada's a great option. You just want dividends in general, Canada's a great option. If you want to buy at a discount, Canada's a great option. And so if you are watching this because you're thinking about investing in Canada, you've seen it in the headlines, there are fantastic options. We talk about them here every single week on the channel. And according to BOA, it's going to continue to outperform. So great place to park your money, great opportunity. And I seriously think that, there are definitely going to be stocks that interest just about every kind of investor. Do I think Canada is going to beat the S&P 500 over the next couple of years? Who knows? Does it really matter? No. Because I think no matter what, we're going to see huge returns in the best companies on the planet. And I think some of those are Canadian. So thanks for watching this video. I hope you enjoyed it. If you did, please do like the video, subscribe to the channel. That makes a huge difference. Doesn't cost anything. And let me know in the comments down below, what's your favorite Canadian company? What stock are you just the highest conviction? I'd love to hear that. And with that being said, I hope I see you in the next one.